Hello, everyone. Welcome back to another episode of the Week in Charts. I'm your host, Charlie Bilello, bringing you, as always, the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a quick moment, hit that subscribe button for all the latest content from us, and we have a lot to talk about today. Short week, but a busy one. Sell in May and go away. You probably have heard that before. I'm going to debunk that once again. Very strong May for the stock market this year. The taco trade got a lot of attention this week. I want to discuss that. Who holds the power to impose tariffs? People assumed, I think, based on the past month, that it was the president. There was a court this week that called that into question. The fastest growing company in history reported earnings this week. We'll dig into the numbers there. Money printing is back. After a brief hiatus, we're seeing the money supply go up again, and I'll talk about the implications there if it really starts to go up at a rapid pace again. Rising delinquencies, latest data from the New York Fed showing higher delinquencies in credit, autos, pretty much across the board. We'll discuss that. Musk is leaving DOGE. We'll talk about what DOGE has said it has accomplished today versus what they set out to do, and we'll end with something positive. As we always do, that would be more affordable rents, a trend I've been talking about for the last 2 years. So let's start out. Sell in May and go away. I'm sure you've heard this one before. We hear it each and every year. One of my big pet peeves. We see articles across the board, different publications, really suggesting that you should get out of the market and sell in May and not get back into the market until November. Here's one headline from MarketWatch. Now there's one more reason for stock market investors to sell in May and go away. That was from a few weeks ago. And the first time I heard this, I said, could that actually be true? I need to test this data. So I took all of the S&P 500 monthly returns, went back to 1928, broke them out between the May and October period, and then the November through April period. What I found very quickly was there was no truth to the saying at all. The stock market still went up during May through October. It just went up less. So here's the numbers here. 3.2% 6-month return on average for the May through October period, 6.2% for the November through April. So still very much positive. And if you dig into the data, you'll find that it's being skewed, this lower return, by a few periods, a few years that were very bad during the May through October period. And if you take those out, the difference is really narrow. And we can see that in looking at the percentage of positive returns during each of these 6-month periods, almost identical. So 72% positive for May through October and 73% positive for the S&P November through April. So your expectation for the May through October period should be the stock market's likely to go up. And the fact that in the past it's gone up less shouldn't really influence you as an investor. It's still going up. So there's absolutely no case to be made based on the data that you should get out of the market, and would have been a mistake. Once again this year, we actually saw the same thing last year, a big return during the month of May. Right now, as I'm talking, this is on Friday, we're looking at 6% return for the S&P 500, which would be the best for May, month of May since the 1990s. So you have to go back a long time. And what's driving it this month is it's all about earnings again. I talked about this a few weeks ago. Of course, April was all about tariffs, the threat of them being put on and then very quickly removed. Well, May has really been all about the earnings reports that have come in, and still pretty good. Hit another high in terms of trailing 12-month earnings with 91% of companies reported. So year over year, profits are going up. And I think a lot of investors were relieved to see the earnings overall for the S&P 500 still trending in the right direction. So if the hysterical thing is that this same publication, MarketWatch, who just a few weeks ago was really imploring investors to get out of the market, getting them to click on this article, talking about all the reasons why you should sell in May and go away. Well, now they have a headline 2 days ago. Investors who followed sell in May and go away are missing what could be the best May for the S&P 500 in decades. So ignore the noise is the lesson here. The media's job is to generate clicks, to generate views. It's not to help educate investors. At Creative Planning, of course, we take the opposite approach. Education is an edge. We make sure all of our clients are informed about what's a signal and what's noise, and sayings like sell in May and go away, very much noise. So if you're looking for a second opinion on your portfolio or financial plan, we do everything at Creative Planning. Reach out to us today. Go to creativeplanning.com/Charlie. Get a free wealth path analysis. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement. So reach out today, creativeplanning.com/Charlie. We're here to help. Number two, the taco trade. This was a hilarious acronym that this Financial Times writer came up with. And really, if you've been watching the markets over the last month, you've probably been noticing this trend where last Friday, here's one example. You have this headline: Trump recommends 50% tariff on European Union starting June 1st. And when I saw this, I immediately said, there's no way this is going to happen. The EU is the biggest trading partner. If you put them all together, all these countries together with the US, there's no way there's any scenario where 50% is going to be put in place for any period of time, because if they did that, the markets would immediately crash and they would reverse course. And it didn't take very long for the administration to do that. You have President Trump just over the weekend saying he agreed to extension, and they're not going to do 50%. And then there's a pause or delay until July 9th, at which point there'll probably be another pause or delay. And the point here is that the markets, I think, are becoming wise to these types of statements, these hyperbolic statements about we're going to put this percent or that percent. And the markets initially in April, if you go back to Liberation Day, were believing that, taking them at face value. And I think increasingly here, they're not believing it. But still, there seems to be an impact. The market did go down about 0.66% last Friday. But immediately over the weekend, that news comes out that there's not going to be 50%. And then on Tuesday, the first day of trading this week, you see the market rocketing higher. So we've seen this pattern probably about 10 or 20 times in the last month, where something big is threatened and then it's pulled back. So this Financial Times writer came up with this taco trade, which is the acronym Trump always chickens out. Of course, Trump did not take kindly to that claim. But any way you want to look at it, I think the big point is that a lot of things are said when it comes to tariffs. You shouldn't take any of them at face value. It's all a negotiation, throwing out big numbers and then coming back. You could say that's a good tactic or a bad tactic, but it's clear that's the tactic. And no one really believes these big numbers when they're thrown out, because we've seen now time and again, once the market reacts a very short period of time, it's immediately reversed in the other direction. So as I'm talking here, we have more headlines. Trump is now accusing China of violating their preliminary trade deal. There was somewhat of a reaction in futures in the morning this morning, but the market almost immediately started reversing course. So I think the more we see this, the more the market becomes desensitized to it. That doesn't mean there isn't still a risk related to tariffs. It doesn't mean there's still not uncertainty and we still don't know what the economic impact of it's going to be. All of that is still true. But I think the scenario that we saw in April, the huge market reaction to some of the comments and some of the proposed policies, I think if you were to do that again today, the market would say, no way that's going to actually happen, and there would be a much more muted reaction. So the big story this week and the big question is who holds the power to impose tariffs. And there was a trade court this week that said that what President Trump did essentially overstepped his authority in terms of imposing these tariffs across the board. And under the act that he did it, essentially, this trade court is arguing, yeah, he has the right to do certain products based on national security, if we're talking about semiconductors or steel or things like that, but to do broad-based tariffs across all of the countries that we're currently doing, they're saying he doesn't have the authority under that act, that would have to be something passed by Congress. A day later, an appeals court says, hold on, the tariffs stay in place. I think ultimately this will have to go to the Supreme Court, who's going to decide whether the president has the authority under the Constitution to impose these tariffs. Now, of course, there's all different ways you can impose them. There's different rules. And so even if they say he can't do it under this one scenario, he could do it under another. But it was very interesting, I think, to see the market's reaction when this trade court said that the tariffs were invalidated. The markets rallied. So I think it's just another message saying the markets overall would be happier without the threat of a huge tariff increase across the board. And we'll see if that ends up happening. Obviously, it's going to be months probably before the Supreme Court would rule on such a thing. But now you have that out there that potentially perhaps some of the tariffs will be ruled invalidated. And so you have to question whether those receipts that we're receiving from tariffs, are we going to have to refund them? If that's the case, it gets much, much more complicated. But ultimately, this question is going to have to be answered, and hopefully sooner or later, so we get some clarity for the markets and companies get clarity as well. So let's talk about the fastest growing company in history. That would be NVIDIA, and I'm just showing you here the best S&P 500 returns, looking at different companies in the index over the last 5 years, 10 years, 15 years, 20 years. And you can see here, NVIDIA at the top of the list for the last 20 years and 15 years and 10 years. Number two over the last 5 years, only trailing Super Micro. And the returns are obviously unbelievable, 66,000% return over the last 20 years. And just looking at $1,000 invested in NVIDIA, what it's done over the last 1, 3, 5 years, we've never seen a company like this in the history of markets, certainly not the size of NVIDIA. So I think we can say, without a doubt, as it stands today, NVIDIA has been the fastest growing company in history. 10 years ago, if you invested $1,000 into NVIDIA, it would be worth over $255,000 today. Just exponential growth. And why did that exponential growth come about? Well, it's because NVIDIA is the power source essentially for this exponential technology that we know now is to be AI. So if we look at NVIDIA and its market share, it is the primary beneficiary so far of the AI revolution, with over 90% market share in its space. And you could see what that looks like in terms of revenue here. We've never seen anything like this for any company in the history of markets. Just a few years ago, you're talking about NVIDIA having revenues on a quarterly basis of $6 billion. Now it's up to $44 billion in its latest quarter. Unbelievable growth. It's projecting $45 billion for the second quarter. And they noted, and this is important because it's related to the tariff situation, we talked about a few months ago the restriction on NVIDIA's H20 chip to China. Well, they noted that their estimate for revenues would have been $8 billion higher if those restrictions weren't put in place. So not a small part of their overall revenue picture. Of course, it remains to be seen if that's going to be lifted or that's going to be changed. Obviously, NVIDIA is lobbying for that to be changed. But if we look at NVIDIA's growth rate, still extremely high here, 69% year over year in the latest quarter. If that number comes in at $45 billion for next quarter, that would be 50% year over year growth. Still very high, but nowhere near where we were last year. So we're in the deceleration phase in terms of NVIDIA, in terms of the growth rates. And notable, I think, for this first quarter report, that net income actually went down. It was the first time we've seen a decline in NVIDIA's net income since 2022. So it's been a long stretch here of just exponential growth in net income, and we see it moving down, still very high, 18.8 billion during the quarter, down from 22.1 billion in the prior quarter. Why did it go down? Once again, related to the tariff issue, where their inability to sell those chips into China, they took a $4 or $5 billion charge to their net income. So net income would have been that much higher if that hadn't occurred, and that directly hit NVIDIA's profit margins. You could see here, NVIDIA was operating at close to record profit margins in the prior quarter, 56% net profit margins, just unbelievable for a company growing at that clip to have a margin that high. Well, in the last quarter, that drops to 43%. So that's going to be the big question. Will NVIDIA be allowed to sell those chips again in China? If it's not, can they replace that demand with someone else in the world, whether it's looking at selling more into the US, into Europe, different areas? Can it replace that level of demand? All of that remains to be seen. But in terms of NVIDIA's market cap, after it reported earnings, NVIDIA's market cap briefly went above Microsoft to become the biggest company in the world, and it's settled in now at second biggest, just behind Microsoft, $3.38 trillion. And what a difference a month makes. A month ago, all of these companies, these big tech companies, biggest companies in the US, were in a sizable drawdown. And after an enormous rally, we now have 9 companies, once again, with a market cap in the US above $1 trillion. You can see Microsoft, NVIDIA, Apple, Amazon, Google, Meta, Tesla, Broadcom, and Berkshire rounding out those 9 companies. Just incredible to see after that tremendous rally over the past month. So speaking of comebacks, money printing is back. Here's a chart of U.S. money supply looking at M2, peaked back in April 2022, and then we had a brief period where it was trending lower. Actually, it was down on a year-over-year basis, something we hadn't seen in the past 80 years. Starts moving up again, you can see in 2024, and now April 2025 back at an all-time high, first time in 3 years. Year-over-year rate of growth, you can see the unbelievable spike that we had a few years ago during COVID, 50% increase over 3 years, 27% over a 1 year period, historically unprecedented. Then we had, with a lag, that spike in inflation. Inflation rate hits 9%, highest since the early 1980s, comes back down. They say, okay, we have to reduce the money supply. This is not good. And actually went down on a year-over-year basis for a pretty long period of time. Looking historically, you could see it had never happened since the beginning of 1960, where we saw a year-over-year decline. But now we're starting to trend up again, up 4.4%. So we have this situation where it seems increasingly likely, if the House bill, unless big changes are made to that House bill that was passed, that we're going to have continued deficits. Higher spending, all else equal, should lead to higher inflation, all else equal. We talked about the bond market's reaction last week on the negative side. Well, what asset classes are responding positively to the prospect of higher inflation, weaker dollar, potentially more growth in the money supply? I'd say 2 asset classes. One would be Bitcoin, of course, hitting record highs once again last week, up moving above 110,000, 111,000 for the first time. The other would be gold, up 28%, having, if you're looking at the gold ETF, on pace to have its best year since inception, which is pretty remarkable. This gold has had a pretty good run the past few years, but on pace to have its best year ever for looking at the gold ETF. On the other side of the coin is the US dollar, off to still one of its worst starts to a year in history. So let's talk about delinquencies here. Latest data from the New York Fed, not very good if we're looking at the U.S. credit card balances moving above 12%. So 12% of these balances are 90 plus days delinquent. Now that's the highest we've seen since 2011. Student loans here, you can see in red, spiking to 7.7%. And this is because the pause on reporting them on people's credit reports just ended. So previous to this, there was a period of time, and you can see here where the delinquency rates just plummeted. And that's because there was a pause in terms of having to pay back your student loans, federal student loans. And then for a period of time after that ended, they weren't, even if you missed a payment, it wasn't going to go on to your credit report. Well, now that period has ended. So we're starting to get back to normal in terms of the student loan market. And that's why we had the spike there. And we have car loans here, the green line, 5% of balances, 90 plus day delinquent. That's the highest we've seen in 5 years. And if we look at mortgages and home equity credit, just a slight increase, still pretty low, but trending up as well. So everything in terms of delinquencies trending higher. So the question is the U.S. consumer in trouble? Well, I'd say more trouble than they were in a few years, but there's a small percentage of people that are running credit card balances or high credit card balances where it's going to impede their spending. Same is true for auto loans. So for certain people, this is certainly a troubling data point for the overall U.S. economy. Not a big impact as of now. If we look at overall in terms of debt service, U.S. consumers still in good shape where the interest payments they're making on all of this debt still a low percentage of their income if you adjust it for that. So something to watch, definitely. You don't want to see this trend higher, but overall not seeing a big impact on it in terms of, is this preventing consumers from spending? Are they taking out less credit? No question. We've seen credit growth go down across the board over the last year, but doesn't seem to be impacting consumer spending just yet. And looking at real personal income, I think this tells the reason why. Real personal income hitting another record high last month, up 2% over the last year. So inflation adjusted incomes hitting record highs once again. If we look at the latest PCE data that came out today, consumer spending still pretty good, great contributor to GDP. And what the expectation is from the Atlanta Fed is that we're going to see second quarter GDP tick up here to over 3.8%. So kind of reversing what we saw in the first quarter. Part of that is consumer spending continued to be strong. The other part is the difference in net exports. So we got an advanced reading on the U.S. trade deficit, and we saw that number plummet for the month of April. So if that continues, let's say in May, we're going to have a reversal of what we saw during the first quarter, which is that really companies pulled forward their purchases. You had a huge deficit, and net exports was a big detractor from real GDP. So what we talked about was the potential for a technical recession in the U.S., but now if this essentially is reversed in course here in April, you're not likely to see that technical recession where we're seeing 2 quarters of negative growth, and consumer spending, importantly, because it's the biggest segment of the economy, still looks pretty strong despite this delinquency data that seems to be moving in the opposite direction. Musk leaving DOGE, another big news story this week. This was expected. He was going to leave. He was a temporary employee. He was supposed to leave at the end of May. And what was the initial promises? The expectations, I think, were pretty high. They were set by Musk himself. I talked about this last year, said, I don't think there's any way in the world that it would be possible to cut $2 trillion. But initially, that's what they were talking about. Very quickly, earlier this year, they changed the rhetoric to cutting at least $1 trillion. That would be a good sign. The best case would be $2 trillion. And as we stand today, what they're saying that they actually cut the savings is $175 billion. I've talked about the problems with this number in the past, but they continue. The wall of receipts that's on the DOGE.gov website, unfortunately, doesn't account for all of this 175 billion. They're saying they've accounted for about 30% of the savings. Well, that leaves obviously a big gap between what they're showing a receipt for and what they're saying they saved. The other issue is if you click on this 175 billion, you click through and look at some of the examples, they're not saying, well, is this for 1 year? Is this for a few years? In many cases, if they canceled, let's say, a lease or a contract that had 5 years and it was 5 billion in total, well, they're saying they saved 5 billion, but really, if you're looking at just this year, it would be 1 billion. So they're not really breaking that out. And of course, until they show all of the receipts, we don't know what was saved and what wasn't. Now, the bigger issue, because clearly they did a lot of good work, clearly they eliminated a lot of waste. There's obviously people that feel strongly that they went overboard in terms of what they cut. But no question, if you go to the DOGE.gov and you dig into some of the things that we were wasting money on, no question, there seems to be at least paused a lot of this spending that was going to wasteful causes. The question is, well, what happens if you don't incorporate those cuts into a congressional bill? And that remains to be seen. And if you look at even Elon Musk's comments as he's going out here, where he's talking about the big, beautiful bill, he's saying he's disappointed to see the massive spending bill, frankly, which increases the budget deficit. So it's hard to reconcile here. Cutting $2 trillion, obviously that's not going to happen. Cutting $1 trillion, not going to happen. And then you have this bill that's passed, which is actually increasing the deficit. So more spending in the bill than we had the year before. So how do you reconcile that versus the cuts that went on? Clearly, I don't think it's 175 billion for this year, but let's say it's half that or a third of that. Well, if you don't make that permanent, if you don't have Congress pass that and say, we're not going to spend money on this next year or the year after, well, there's a potential that this spending will actually resume. So if you want to say that this is wasteful, you want to say that this shouldn't be in the budget, well, get Congress to actually put it in the bill and pass it. I think it would be a real shame if they did all this work and they're showing that there's actual fraud, waste, and abuse, and then we let that lapse because Musk leaves. He has to obviously give more attention to Tesla and the other companies that he's running, but that would be a real shame to let all of the work and transparency go to waste. So a good start. It's only been 130 days. Make the improvements here. Get to the point before, this is what I said a month ago or 2 months ago, don't announce any more savings until you can account for 100% of what you're saying you already saved. So it shouldn't be 30% of total savings. It should be 100%. Don't announce it until you have the proof to show it, because obviously you lose credibility when you're promising to show it in the future. Why can't you show it today? And two, you have to work with Congress to codify these cuts. If you don't believe they should be in the budget, we'll make the case to Congress and have them say they should cut this out of the budget to make it more permanent. Now, of course, none of this is permanent because a future Congress could say, we want to spend money here, we want to spend money there, but at least you have the standpoint then of having them debate it, getting it out in the open. I think a lot of this spending was simply nobody had looked at it for years, maybe decades, and we just were increasing spending year after year. So if we're going to give Elon Musk a grade, A for effort, but definitely an incomplete in terms of what they set out to accomplish and what they actually accomplished. I think it just proves, and he probably, I'm sure, was frustrated that actually doing something about the bureaucracy and actually cutting spending at the end of the day, very, very difficult, because you have all these different constituencies and you have all these different politicians that want to continue the status quo. They want to continue to get elected. And by promising to cut things, well, that's not how you generally get elected. And this started out with a lot of goodwill where people were essentially saying we need to do something about the deficit. All of the polls showed a concern a few months ago. We can't continue down this path. But here we are today where we have this bill potentially that's going to be signed within the next few months. That's going to really negate a lot of the work that went into the DOGE effort. So we'll see how it shakes out. Hopefully there'll be something lasting from this, at least from a transparency standpoint. But you have to get, I think this proves, you have to get Congress involved to make it permanent. If you don't think something should be in there, have them pass a law to say, we're cutting this in terms of spending. So I want to end, as we always do, with something positive, and that would be more affordable rents. You can see from this chart here, 24 consecutive months now where rents are going down on a year-over-year basis. Big change from what happened prior to that. And if we're looking at why rents are becoming more affordable, well, this chart really tells that story. Hourly earnings now outpacing the increase in U.S. rents since the beginning of 2020. So you had this period of time where rents were just skyrocketing, outpacing people's wages. Bad situation, particularly in 2022. But since then, rents have gone sideways. If you look at nominal rents in the U.S., sideways to down, while hourly earnings continue to go up. So now, much better position. So similar chart that I always show in terms of real wage growth in the U.S. and how important that is to be positive. Well, this is showing you the biggest thing that people spend money on, which is housing, and a lot of people still rent in terms of a house or an apartment. This is showing you that in the actual data here, people's earnings are going up more than that. Very good thing, because it leaves more money for you to spend, to save, to invest. So great trend. And if you're renting and you're thinking about buying a home, well, if you could buy a home and you can afford that home and you plan to live in it for a long time, that could be a good decision, but certainly not a good decision if you're going to be stretching, you're going to be spending 50% of your money on that housing payment. It's going to crowd out everything else in your life. And if we look at Bankrate's latest analysis, renting a home is actually cheaper than buying a house, paying a mortgage in all 50 of the largest U.S. metropolitan areas in 2025. So this is not always the case historically, but it is the case today because of what we're seeing in this chart, where rents have gone sideways to down over the last few years, while U.S. home prices continue to go up and continue to outpace wage growth. So big disparity in terms of the rental market and housing market to purchase. I talked about last week why my expectation is for U.S. home prices on a real basis, inflation-adjusted basis, to start to decline in the U.S. We could see a decade, I think, of no real appreciation in terms of the housing market if you adjust for inflation. Simply, it's too big of a gap between what you would pay to buy a home versus rent a home. So it's likely that we're going to see that gap close in the coming months and years. So let's end it right there. Thanks everyone for joining me on the Week in Charts. Have a great weekend. If you're watching this on YouTube, hit that subscribe button for all the latest content from us, and I'll see you next time on the Week in Charts.